In this video, we're going to talk about Mullen Automotive, trading under the ticker symbol MULN. Right now, the financial market is having a lot of volatilities, and we have to be careful about which stocks to buy and the exposure and timing of our trades. Today's video is going to cover the recent price actions and the technical aspects of the stock. So far in this week, the stock increased to about $1.91 before closing the trading day at $1.60. So we should pay attention to the $1.97 level nearby because that level has been tested multiple times as a potential resistance, and it is certainly a key level to watch out for to determine if, in the short term, Mullen will have enough steam to keep pushing the stock upward in the short and medium term. Over the past 30 days, the trend of the stock has been, I would say, bottoming out of the current bearish trend, and right now the market is testing the water to see if there is enough appetite to start a new trend. From the perspective of a longer time frame, which is 6 months and above, the trend of the stock has been bearish, as the EV startup was affected by the sell-off across the board of the Nasdaq, and was also affected by the supply chain issues and commodity price increase caused by the real-world events. When we look at the price trend overall, it's been reversed from recent bullish trend, which is likely going to be combined with a decrease of selling positions because they have already unloaded the bulk of what they have, which mechanically increases the ratio of long positions. There is also the element of larger environment believing that the stock is oversold, and a lot of people are wondering whether now is the time to get in. It's interesting to use the stock as an example actually to stretch how important it is to aim for the right timing to enter in a stock, as the small position I have entered into about a week ago has now increased its value by almost 100%. Certainly it's a small position, but that is exactly the point, so that I can afford to let it run its course without being affected by emotions in the short term. The trading volume of Mullen Automotive has recently been 229 million shares versus the average volume of 185 million shares. Over the previous 52-week period, its price fluctuated between 52 cents and $15.90. The market cap of Mullen Automotive is currently at $61 million versus the enterprise value of $113 million. The difference between the market cap and the enterprise value is the premium or the discount the financial market is willing to allocate to the company based on its current fundamentals, leverage, and asset composition. The enterprise value is the combined value of the company's assets minus the debts. If the company has a lot of debts or a negative image in the market, the asset's value may be impaired. But with that being said, at the end of the day, it remains an estimation from the market every single time this company publishes its financial statements. So it's less reactive than the market cap, which is reflected every single trading day, and often more lenient, I would say, for startups. One key element to note regarding the enterprise value is that for many growth-type companies, one of the most significant assets they own is called goodwill. Goodwill is an expectation of the market that the company is able to generate more profit or to have more growth than another company, partially because it may have a better management, a stronger brand recognition, and a bigger online following. It's basically what makes this company unique versus its competition. In other words, it's not a tangible asset that companies can use. It's often the reason why some companies are perceived to be trading at a discount, because the market cap is lower than the enterprise value, and because it is also less reactive than the market cap in very volatile situations. If the company goes to liquidation, the goodwill would be depreciated entirely, and we would be left with potentially less assets to share among the shareholders and the bondholders than what we currently see on the balance sheet. When we compare the current price to its historical price fluctuations, the stock is 208% higher than its 1-month low, 208% higher than the 3-month low, and 208% higher than the 52-week low. on the options market, often giving a hint on the market sentiment on where the stock price is likely going to head next. The implied volatility is 367% versus a historical volatility of 371%. The put-call volume ratio is currently at 0.16. It's normal for many stocks to also have a higher put option volume than what they deserve, as many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 72,000 contracts in a day versus the 30-day average volume of 36,000. Regarding the open interest, the most recent volume of open interest is 208,000 contracts versus the 30-day average of 79,000 contracts. In terms of shareholder structure, institutional shareholders own about 4% of the float. The biggest shareholders include Vanguard, BlackRock, and iShares. It's relevant to understand the shareholder composition of a company as it helps us to determine if you should hold the stock long-term or to view it as a trade opportunity. If the stock is mainly held by retail traders, then this can potentially be a sign that the stock lacks the depth to justify long-term trust from shareholders. The consensus is that there should be at least 25 to 30% of institutional participation for the stock to be perceived as a sound investment and not just a short-term trade. There's a lot of exceptions to this since many great titles are mostly held by retail traders as well. But that tends to be the exception and not the rule. Let's also take a look at the short interest present in the stock, which is the amount of positions aiming to profit if the share price falls lower. Sometimes when there are a significant short interest in the total volume, this can be a sign that there is an organized shorting operation going on. The current short interest is about 20% of the total float, with 35% of the transactions coming out of the dark pool. Overall, my opinion about Mullen Automotive is bullish, because Mullen will benefit from the recovery that is probably going to occur over the next couple of weeks, and hopefully the market condition for NASDAQ will also improve during that period of time. The maximum exposure I would recommend is 3 to 5% of your portfolio. For the immediate term, my recommendation is to buy the stock considering the recent price actions and the promising price levels that are close to where the stock is at the moment. I would recommend to separate the allocations in batches of 10% at a time so that you can have enough room for later purchases. In this current market environment, I believe that we should be careful about taking positions and risk in the financial market in general, and in the equity market in particular. Because over the past decade or so, the financial market has been living with the help of newly created capital from QEs, resulting in a massive increase of asset prices and the corresponding decrease in their yields. And the low interest rate also contributed to reinforce this phenomenon because the financial sector would see its profit margins reduced and in turn keeps the returns of other sectors and employees low as well. At the same time, the market doesn't represent the real economy, and the real economy doesn't get reflected in the price of different securities. The market is a game of supply and demand, which will depend on a number of factors, not just the fundamentals. If the asset prices only depend on the fundamentals, then their performances in the Northern Hemisphere would have been more than mediocre, because things have been mostly stagnant over the years. A few things can explain why asset prices managed to remain high despite the stagnation of the underlying businesses. The first one is that over the years, there has been more money printed by different central banks to support their own economies. But because that money is distributed to banks and expected to loan to businesses to create more jobs, and that in fact there aren't that many opportunities out there, this money became capital that travels around the world and went into the huge financial melting pot. The QEs are now wrapping up in many countries, so I don't think that it'll remain as the main driving force over the next couple of years to keep the asset prices up. But it's compensated by the arrival of new capital from different regions to North America because it's perceived as a safe haven for investors. With the rising tensions around the world, this capital inflow will probably be sustained over the next couple of years, if not intensifying. The last phenomenon is the creation of artificial bubbles that are either supported by real market trends or completely fictional ones to allow market participants to play the game of hot potato and to either create profits or to safekeep their capital. The EV sector back in 2020 is an excellent example of this. But nevertheless, what it means for the market is that the degree of uncertainty is probably going to increase over the foreseeable future, as the expectation for a recession has been building up for more than a decade, and that the economic difficulties are accumulating around the world, especially from Asia. What this means for the market and for us is that the volatility is supposed to increase over time, which will provide opportunities to make a profit or to incur losses, depending on the timing and risk management. Another thing to note for this period of time is that we have to be very careful about having shorts. It's already riskier than having longs because the losses of shorts are not limited, right? Because there's no limit in terms of how far the stock can increase. But with the increased involvement of short sellers, I believe that the stocks been shorted will have an even higher probability of getting squeezed, which will result in potentially massive losses. So we're also observing more of an irrational behavior from market participants in the sense that very often people will choose to rush in a position not necessarily because the fundamentals are convincing, but because there's a buildup of demand in a specific stock and people will pile in to ride the gravy train with the rest of us. That kind of behavior is highly risky and may result in losses. It's worth pointing out that in 2020 and probably in 2021, the market has never presented that many opportunities, but it was also during that same period of time that many retail traders have incurred their biggest losses. A rule of thumb is that each position should be structured so that even if they don't succeed, they don't impact the portfolio stability. Positions should begin small so that there is an opportunity to average down later. And specifically for the growth stocks, I think that 5 to 10% overall should be a healthy weight for the portfolio. And each stock should represent about 1 to 3% of the positions. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.